Hi everyone, and welcome to a brand new episode. I'm Marcus, and today we're looking at Adobe, ticker symbol ADBE. We'll cover the income statement, balance sheet, cash flow, key figures, our key feature, and the technical aspect of the stock. So the stock have dropped more than 40% since November 2021, and the price is right now moving at a key area, making it very interesting. But should we be buying? Well, let's find out. So Adobe is traded on NASDAQ and are in the technology sector. If we go down to the screen, we can see that their market capitalization coming in at $198 billion and the revenues at $16 billion. Now PE ratio coming in at 41.7. Guys, I like company with a PE ratio of 20 or below, so having 41.7, that is too high for me, so that is a no. But at the same time, when you see a stock with a high PE ratio, that basically tells you that the market expectation of that stock is high, and therefore there are a good chance that you might see capital gains on those stocks because there's a lot of investors coming in and pushing the price even higher because they're expecting better and better numbers. But the overhanging risk that we have seen with Facebook, PayPal, and many others is that if the company cannot meet those expectations, we will see the stock price fall. Same thing goes when you see a stock with low PE ratio. That tells you that the market expectation of that stock is low, and therefore you might not see capital gains on those stocks because the market doesn't expect much from those stocks. Now, profit margin coming in at 29.9%. I like it because I like companies with a profit margin of 15% or higher. So coming in at 29.9, I like it. So that is a go for me. Price to sales ratio coming in at 12. Normally I like companies with a price to sales ratio of maximum 4. So coming in at 12, that is just too high for me. So that is a no. Price to book value coming in at 14.9. Normally I like companies with a price to book value of maximum 3. So 14, that is just too high for me. So that is a no. So if we were to summarize, PE ratio is too high, price to sales ratio is too high, and price to book value is too high. This tells me that Adobe at its current state is overvalued. Now they don't pay out any dividend, which is a shame because I like those recurrent income, and we can see here return on equity is at 35%. I like it. Basically, return on equity tells you about a company's ability to create return on their equity, and as for the investor, that means their ability to create return on the capital you're about to invest in them. So seeing at 35%, I like it. So that is a go. Return on assets coming in at 14.5%. I like it. So that is a go. Now, so the stock is currently traded at $420 per share, and if we go down to the moving average, we can see that we are below the 50-day moving average, but also below the 200-day moving average. So what is this telling us? Well, the indicator is telling us that we might see the stock price decline. But if we take a quick glance on the chart, we can see that we have been moving within a positive trend channel for quite some time, but as of lately seen lower and lower levels. But we'll take a closer look at the technical aspect further down. But let's jump over to the income statement. And what we can see here is that the total revenue went from $7.3 billion up to $15.8 billion, and these numbers have been growing steadily every year. I like it. So that is a plus. Gross profit went from $6.3 billion up to $13.9 billion, and these numbers have been improving every year. I like it. Net income went from $1.7 billion up to $4.8 billion. Same trend here, that these numbers have been improving. I like it. Now let's jump over to the balance sheet. What we're interested here is that the current assets versus the current liabilities, and we can see there is a huge difference between the current assets and the current liabilities, and that is a plus. Basically, what this is telling us is that if the company were to convert their current assets to cash, they're able to pay off their current liabilities, but they are far from being able to pay off their total liabilities, which is negative. And if we look at the total liabilities, we can see that it has gone from $6.1 billion up to $12.4 billion, and these numbers have been growing steadily every year. That is a negative. I would like to see the company reduce their total liabilities, also reduce the rate which the total liabilities are growing. Now let's look at the outstanding shares, and we can see it went from 491 million outstanding shares down to 474 175 million, and we can see that these numbers have been dropping over the past 5 years, which is a plus. Basically what this is telling us is that when you see these numbers decrease, that means that the company is doing buybacks. They're buying back their shares, and there are fewer and fewer available shares out there, making your share of the company grow. But if we were to see these numbers increase, that would mean that there are companies issuing more and more shares, meaning that there are more and more available shares out there, making your share of the company decrease, meaning that you are being diluted as an investor. And there's a lot of investors that either skip this part or doesn't know about it, because they be looking at a company's balance sheet and they see a company with a lot of assets and the debt is not growing that much, which is great. This is what we're all looking for. But on the other hand, we can see that the company is issuing more and more share, which is negative. But at the same time, this is a way for a company to bring in more capital without taking on more debt. So remember, when you'll be looking at the balance sheet, don't just look at the assets and the debt, but also on the number of outstanding shares, because it could happen that you're being diluted as an investor. Now let's jump over to the cash flow, and what we're interested in here is that the operating cash flow versus the capital expenditure, and we can see that the operating cash flow came in at $7.2 billion and the capital expenditure at $348 million, making this a difference of $6.9 billion, and that is a plus. We can also see that the operating cash flow went from $2.9 billion up to $7.2 billion, and these numbers have been improving every year. I like it. Capital expenditure went from $178 million up to $348, and these numbers have been improving. I like it. We fell off a bit in 2021, but overall trend is positive. I like that the operating cash flow is improving, also that they continue to invest in the business. This is amazing. Now let's jump over to the key figures, and what we can see here is that the earnings per share went from $3.4 per share up to $10 per share, and these numbers have been improving. We fell off a bit in 2021, but overall trend is positive. Revenue per share went from $14.8 per share up to $33.2 per share, and these numbers have been improving every year. I like it. Equity per share went from $17 per share up to $31 per share, and these numbers have been improving every year. That is a plus. It is a shame they don't pay out any dividends, because I like company that pays out dividends, and also where the dividends are growing every year, because I like those recurring income. Now gross margin went from 86% up to 88%, and these numbers, it's not a lot of fluctuation, but still these numbers are moving in the right direction, and that is a plus. But also at the same time, we need to look at across the industry, how is Adobe doing compared to the competitors? By seeing a gross profit of 88%, I like it. So that is a plus. Operating margin went from 29% up to 36%, and these numbers have been improving. We fell off a bit in 2019, but overall trend is positive. I like it. Profit margin went from 23% up to 30.5%, and these numbers have been improving. We fell off a bit in 2019, but overall trend is positive. Fell off again in 2021, but as I said, it is moving in the right direction. That is a plus. Return on equity went from 20% up to 32.5%, and these numbers have been improving every year. We fell off a bit in 2021, but overall trend is positive. Return on assets went from 11.6% up to 17.7%, and same thing here. These numbers have been improving. We fell off a bit, but overall trend is positive. Solidity went from 58% up down to 54%, and basically solidity tells you about a company's financial strength for the long term, and we can see that these numbers have been fluctuating a bit, but overall trend is negative. Balance sheet liquidity went from 10.8% down to 10.8 down to 1.5. We can see a bit of fluctuation here, but the overall trend is negative. Balance sheet liquidity, same thing as a solidity, but here it looks at the company's financial strength for the short term. And debt ratio went from 0.7 up to 0.8, and we can see that these numbers have been fluctuating, but these numbers are growing, so that is negative. Basically, the debt ratio in 2020 was 0.8, meaning that they had 0.8 times more debt than equity. So these numbers is not large, it's not huge, but we can see that it's moving in the wrong direction. So guys, we have gone through the income statement, balance sheet, cash flow, key figures. Now over to our key feature, which is the stock analyzer. And what the stock analyzer does is that it gives you a simplified, holistic overview of the company's performance. If you want to dig through the numbers, you can dig through the numbers or have the software do the heavy lifting for you. If we go down to the screen, we can see that the PE ratio is above 20, which is negative. Don't pay any dividend, which is negative, but the number of outstanding shares have decreased, which is positive, and the revenue increased over the past 5 years, positive. Profit margin above 15%, positive, and profit decreased the last year, but overall trend is negative, so that is negative here. Current assets is greater than current liabilities, positive. Solidity decreased over the past 5 years, negative. Balance sheet liquidity decreased over the past 5 years, negative. Debt equity ratio increased over the past 5 years, negative, and the total liabilities have grown for the past 5 years, negative. Guys, as you can tell, it gives you a simplified, holistic overview of the company's performance, and it saves you a lot of time. If you want to dig through the numbers, you can dig through the numbers or have the software do the heavy lifting for you. You can have this software along with everything we've gone through and able to chat with me along with other members for only $10 per month. So make sure to head over to commerce.sc and become a member today. Okay, thank you. But now let's look at the technical aspect of the stock. So here we have the chart. As you guys can tell, we have been moving within a positive trend channel for many years, and the trend is still going, but we have lately seen a drop since November 2021, seen this number drop back to the channel. And right now, where we are right now is at key areas. As you can tell, if we zoom out a bit, that we have been here before. So basically, I believe there's a lot of investor been looking at this and see, okay, this is a potential buy for a potential price move of, let me see here, of 70%. Now this price move will take a couple of years, but one negative thing is that they don't pay out any dividends. So if you want to buy this stock, well, you need to believe in what the company is doing, and you need to believe in their potential and the market going forward, because we have a lot of uncertainties short term, but for the long term, I believe there's a lot of investor right now waiting and seeing. And we can see, if we take a closer look, that we are more or less consolidating, meaning that the market doesn't know whether it will go up or will go down. But I believe going forward that we will see the stock price increase and go back and continue the trend upwards, the resistance area right here. But as I mentioned, this will take a couple of years. It will take a lot of time. But on the other hand, short term, we could see there is a risk that the price continues moving below the channel before getting back up again for a retest. But if the price were to break below this area, then that would be a signal that the price will continue to move down. But I believe for the long term that the price will continue back up. So if I were to summarize my thoughts of the company, so Adobe is a large and stable company. It is currently overvalued, but I do like the fact that the revenue and the profits are growing and the profit margin is above 15%. I also like that the current assets are greater than the current liabilities. And even though the number of outstanding shares have not changed much during the past 5 years, I like that they have been doing stock buybacks and increasing the investor share of the company. Another thing I like about the company is that the total liabilities is not growing in the same rate as we have seen on many other companies. There's a lot of positive things about the company. The cash flow from operations is improving year over year, and they continue to invest in the business. But some of their challenges is that they need to improve their solidity, balance sheet liquidity, and debt ratio, basically improving their finances for uncertainties. So the question we're all asking ourselves, should we be buying? Well, they don't pay any dividends, but looking at the chart, the price is right at the key levels right now, and we could eventually, if we buy and hold for multiple years, we could see the price increase to the $700 levels, making us a 70% price move. But as always, nothing is for certain. The climate short term consists of a lot of challenges, ranging from a high inflation rate, potential recession, increased interest rates, and we are already seeing a lower consumer confidence due to high inflation. But at the same time, we are seeing lower unemployment rate. U.S. job vacancies are dropping, meaning that companies are finding workers, and labor market participation is improving. So there's a lot of uncertainties, and therefore short term we could have a bumper ride ahead of us. But long term, I think Adobe is potential stock to add to the portfolio. If I would score the company, I would give them a score of 58%. So that's how I would trade the stock. How would you trade the stock? Please let me know in the comment section below, and also let me know if you have any questions or have stocks you want me to look at. And as always, please do your own analysis, and thank you so much for watching. I am truly grateful and I appreciate it. And if you have enjoyed this episode, please give me a thumbs up, comment, subscribe, and until next time guys, take care. Bye bye.